Welcome to the Deep Dive. Today we're on a very specific mission, a high-stakes one, actually. We're preparing you not just to pass the NLS SAFE exam, but to absolutely ace it, get that perfect score. And our focus for this deep dive, the Equal Credit Opportunity Act, ECOA. And of course, it's critical implementing Regulation B. Every single piece of information we're about to unpack, every number, every precise definition, it's all meticulously chosen. Why? Because it's a potential point on your exam. We're aiming to give you that edge, that shortcut to knowing exactly what you need to recall under pressure for that perfect score.
That's precisely it. Think of this as your intensive training session, focused. The NMLS SAFE exam, it demands precision, absolute precision, especially when it comes to understanding ECO, which, people often just call Regulation B. They're pretty much synonymous in practice. So as your guide today, I'm going to break down the core requirements, pinpoint those exact timelines, and really highlight those nuanced details and common pitfalls, the things that separate a pass from that perfect 100. Our goal together is to make sure you don't just kind of grasp this stuff conceptually, but that you can pull these crucial facts out with total accuracy the second you see them on the test. Let's make every detail count towards that perfect score.
Okay, let's unpack this then, starting with the basics, the fundamental why. Why did Congress even feel the need to enact ECOA back in 1974? What problem were they really trying to solve?
That's the perfect place to start. Because knowing the why really gives context to the what. Before ECOA, well, there was widespread discrimination in lending, often blatant, actually. Historically, there was tons of anecdotal evidence, plus studies showing clearly that certain groups, particularly women, they were just denied credit or offered worse terms simply because of their gender or their marital status or even, just the possibility of future life changes.
Wow, like potentially getting pregnant.
Exactly. Imagine a woman, totally creditworthy, great income, strong financial history, applying for a mortgage, only to be denied because some lender just assumed she might get pregnant and stop working. Or maybe they figured her income wasn't as reliable as a man's. Or that her husband had to sign, regardless of her own financial strength. This stuff was pervasive. It really was. So ECOA was Congress's direct shot at stamping out those discriminatory practices and making sure everyone who's creditworthy has fair access to credit.
So the core purpose is clear. Fairness. Can you lay out for us the specific protections ECOA offers? This list. It feels like something you absolutely need burned into your memory for the exam.
Oh, you're absolutely right. This list is foundational. It will be tested. You need to know this. The law is meant to promote the availability of credit to all creditworthy applicants regardless of. Okay, here's the list. 1. Race. 2. Color. 3. Religion. 4. National origin. 5. Sex. And it's really crucial to remember this now explicitly includes sexual orientation and gender identity. That's a vital update.
Okay, so sex is broader than maybe originally intended. Good point.
Yes. Then 6, marital status. 7, age. But with a key condition, the applicant has to be old enough to legally enter into a contract. 8, receiving income from a public assistance program. And 9, having exercised rights under the Consumer Credit Protection Act.
That whole list. 9 protected bases.
9 protected bases. Non-negotiable for your perfect score. You need to be able to recite it, understand each one, and recognize when they're being improperly used in a lending decision. It's not just memorization, you see. It's about applying it, recognizing these in the scenarios the exam throws at you.
Right. So Congress passes ECOA, but laws need rules to actually work in practice. That's where Regulation B comes in, is that correct? And who are the key players? Who's actually enforcing this stuff?
Precisely. ECOA, the statute, gets implemented through regulations. And for this one, it's Regulation B. Now, for your exam, specifically note the citation. 12 CFR Section 1002.1 at SEC, that 12 CFR Code of Federal Regulations, Title 12, Banks and Banking. And the section number tells you where Reg B starts. It seems technical, but recognizing that citation, important.
Okay, 12 CFR 1002. Got it?
Right.
And enforcement.
Right, enforcement. The primary federal agency responsible, that's the Consumer Financial Protection Bureau, CFPB. They implement and enforce ECOA. And within the CFPB, there's a specific group, the Office of Fair Lending and Equal Opportunity. They're directly responsible. However, and this is a common exam point to remember, the Federal Trade Commission, FTC, also has some enforcement authority.
The FTC too. Okay, how does that work?
Yeah, the FTC's role is mainly over non-depository institutions. So think lenders that aren't traditional banks or credit unions, like independent mortgage companies, maybe some other types of finance companies. So yeah, CFPB is your main answer for enforcement, but always keep the FTC in mind for its specific scope. Knowing these agencies, knowing their roles, absolutely fundamental for the test.
That distinction is really vital. So it sounds like ECOA casts a pretty wide net then. What kinds of loans, what kinds of entities are actually covered? Because it feels incredibly broad.
Oh, it absolutely is broad. And this is definitely an area where people get tripped up on the exam. They think it's just, consumer mortgages. Let's be super clear. ECOA applies to transactions for extending credit by any person who regularly extends, renews, or continues credit. That phrase, regularly, that's key. Anyone in the business of lending, basically. But wait, it goes even further. It also explicitly applies to anyone who regularly refers applicants to creditors or offers to select creditors to whom requests for credit can be made.
Ah, so that sounds like.
Exactly. This is critically important for your profession. This definition explicitly includes mortgage brokers. Mortgage brokers, just by referring applicants to lenders, you fall under ECOA's rules. Period.
Okay, that's huge. Brokers are definitely covered.
Definitely. Now, here's another crucial differentiator. Think about other laws like RESPA or TILA. They mostly focus on consumer credit, right? Personal, family, household stuff. ECOA is unique. It also applies to extensions of credit for business, commercial, and agricultural purposes.
Wait, really? Business and farm loans too?
Yes. A loan for a new tractor, a line of credit for a small business, financing for a commercial building, all subject to ECOA's anti-discrimination rules. This is a super common test question that tries to catch you out, differentiating ECOA from other regs. Do not overlook this distinction. Mark it down. Extremely important for your memorization. It trips people up all the time.
All right, section 2. Here's where we get into the vocabulary. The absolute must-know terms for your exam. These aren't just legal jargon. They're concepts you have to understand precisely and recall instantly. Let's dive into the critical definitions.
Absolutely. Precision here is paramount. You need these for full points. First up, adverse action. Simple terms. It's a creditor's refusal to give you credit in the amount or on the terms you asked for. So you apply for a $300K mortgage at 5%. They only offer $250K. Adverse action. Or they offer the $300 but bump the rate to 6%. Also adverse action, because the terms are worse than you requested.
Okay, so not just a flat no. Less favorable counts too.
Exactly.
Yeah.
Now, there's an important nuance for open-end credit. Think credit cards, HELOCs. For open-end, adverse action also includes terminating an account or making an unfavorable change to the terms, like hiking the rate on your existing balance, not just new buys, or just refusing to increase your credit line. Pay close attention to those open-end specifics. The exam might test those.
Got it. Open-end has broader definitions.
Yeah.
What's next?
Next, discriminate. This means using a prohibited basis like race, color, sex to treat a loan applicant less favorably than other applicants. It's that direct, unequal treatment because of a protected characteristic. Like if a lender always gives higher rates to applicants from a certain national origin, even if their credit profiles are identical to others getting lower rates. Clear discrimination.
Straightforward enough. How about elderly?
Elderly. Very specific number here. Memorize this. Age 62 or older. That's the definition under ECO. 62. Commit that number to memory.
62 or older. Easy point. Okay, marital status.
Marital status refers to the state of being unmarried, married, or separated. Now, here is a crucial, absolutely critical detail for your perfect score. Frequently tested, often missed. The term unmarried specifically refers to people who are single, divorced, or widowed. And critically, these three terms, unmarried, married, or separated, are the only terms creditors are allowed to use when asking about marital status.
Only those three. Unmarried, married, separated.
Only those three. I'll repeat it because it's that important for the exam. Only those three. Asking if someone is single or divorced or widowed directly, or asking if they're cohabitating. Violation. The specific terminology here is absolutely key.
Wow. Okay. That's incredibly precise and exactly the level of detail we need. So with those terms locked down, let's hammer that list of prohibited bases again. For a perfect score, you need this instantly recalled, right?
Absolutely. This list, it's the backbone of ECOA. Your ability to just reel it off from memory is fundamental, not just recognize it, recall it. Discrimination is forbidden based on 1. Race. Can't deny or give worse terms based on race. 2. Color. Similar. Deals with skin tone. 3. Religion. Can't discriminate based on beliefs. 4. National origin. Where you're from, your ethnicity. Can't treat someone differently because they're from, say, Ireland or India. 5. Sex. And remember, broad category. Explicitly includes sexual orientation and gender identity. No discrimination because someone's male, female, trans, gay, lesbian. Forbidden. 6. Marital status. Remember the only terms. Unmarried, married, separated. Can't treat someone differently because they're single or divorced, assuming they can contract. 7. Age. You can check if they're old enough to sign a contract, sure, but you can't discriminate just because they're elderly, say 62 or older, if they're creditworthy and legally capable. Comes up with retirement income a lot. 8. Receipt of income from a public assistance program. Social Security, disability, welfare, whatever. If it's consistent, verifiable income. Must be considered like any other income. Can't hold it against them. 9. Having exercised rights under the Consumer Credit Protection Act, CCPA, this is critical, filed for bankruptcy. Used credit counseling. Can't deny or treat them worse just for exercising those legal rights.
Okay, that list is dense, but crucial. Race, color, religion, national origin, sex, marital status, age, public assistance income, exercising CCPA rights. Got it.
You need to internalize that list completely. It will show up in various scenarios on the SAFE exam. Commit it to memory now.
All right, let's shift gears to the timing rules. These numbers, these deadlines, they were tested heavily on the SAFE exam. Missing just one of these could literally be the difference between passing and that perfect score. So, listeners, focus up. This is intense.
You are absolutely right. These timelines. Critical for your perfect score. Let's start right at the beginning. Actions required upon or within 3 business days of application.
3 business days. Okay, what happens then?
First, the notice of right to receive appraisal report. A creditor must notify an applicant they have a right to get a copy of all written appraisals and valuations for the transaction. It's not optional, it's required.
Right.
And the timing. Due within 3 business days of receiving a loan application, but specifically for a mortgage that will be secured by a first lien on a dwelling.
Okay, specific condition there. First land, dwelling, 3 business days for the notice.
Precisely. Notice of the right, 3 business days. First, land on a dwelling, differentiate that from other appraisal rules. Second, the actual copy of appraisals and valuations, the documents themselves. A copy of all appraisals and other written valuations must be given to the applicant promptly when they're completed, or at least 3 business days prior to consummation, whichever is earlier.
Whoa, okay, so 3 days again, but this time it's 3 days before closing. Or sooner if the appraisal is done.
Exactly. So the notice is within 3 days of applying. The actual copy is 3 business days before closing or as soon as it's done, whichever gives the applicant more time. The idea is to give them enough time to look it over, maybe question it, before they commit to the loan. Now here's a key detail. Often on the exam, borrowers can waive this timing requirement.
They can waive the 3 days before closing.
Yes, they can agree to receive their copy at or before consummation. Maybe closing needs to happen fast, appraisal comes in late. If they waive it, it has to be in writing. But even with a waiver, they still have the right to get it 3 days prior if they don't waive. Understand that waiver possibility. It's important.
Okay, notice within 3 days of app, copy 3 days before closing, unless waived. Got it. Now, you mentioned the 30-day rule. That pops up everywhere in lending recs. How does it work in ECOA? There seem to be multiple uses. How do we keep them straight for the exam?
Excellent question. Because yes, 30 days shows up a few times, each meaning something distinct. You absolutely must know these distinctions. First use. Notifications of action taken within 30 days of a completed application. A creditor has to notify a consumer, in writing, about the action taken within 30 days of getting a completed loan application. And completed means the creditor has all the info they usually need to decide.
So once they have everything they need, the 30-day clock starts. What if it's bad news?
Right. If the action is adverse denied or offered worse terms, the notice must be written, and it must state the specific reasons. Can't just say denied, gotta say why. Denied due to insufficient income, high DTI, something specific. Plus, the notice needs the creditor's name address, an ECOA non-discrimination statement, the name address of the federal agency enforcing compliance for that creditor, and if the denial was based on a credit report, info on the credit reporting agency, Equifax, Experian, etc., and how to get a free report must be included too. Emphasize completed application and that 30 days deadline for action, crucial communication rule.
Okay, 30 days from completed app for a decision with specific reasons if adverse. What if the app is incomplete?
Good point. Sometimes an application is missing stuff, right? Income docs, property address. In that case, within 30 days of getting that incomplete application, the creditor has 2 choices. Option A, send a notice of action taken, basically denying it because it's incomplete. Option B, send a notice of incompleteness. This notice has to say exactly what info is needed, set a reasonable deadline for submitting it, like 15 or 30 days, and warn the applicant that if they don't provide it, the application won't be considered further. So again, 30 days is key for incomplete apps. But remember the 2 different paths the creditor can take.
30 days for incomplete too, but 2 options, deny or ask for more info. Makes sense. Is there another timing rule?
Yes, there's a slightly different one. Within 90 days of a counteroffer. Let's say a creditor can't approve the loan exactly as requested, but they offer different terms. Smaller amount, higher rate. That's a counteroffer. If the applicant doesn't explicitly say, yes, I accept that counteroffer, then the creditor has to notify the applicant of the action taken, or that the original app is now considered withdrawn, within 90 days after making that counteroffer. So remember 90 days. Specific timeline for counteroffers that aren't accepted. Don't mix it up with the 30-day rules for initial decisions. This is about closing the loop on that specific counteroffer.
90 days for unaccepted counteroffers. Okay, so those cover decisions on the applications themselves. But even after a decision like a denial, there are still timeframes to know, right? Especially about getting more info.
Indeed. These are also tested often, particularly how the applicant's right to ask for info interacts with the creditor's duty to provide it. First, 30 days. Denied withdrawn application for valuations. Remember we talked about getting appraisal copies before closing. What if the loan doesn't close? It gets denied by the creditor or withdrawn by the consumer. The obligation to provide copies of all valuations, appraisals, AVMs, whatever, it still exists, but the deadline changes. In this specific case, it's extended to 30 days after the date the creditor figures out the deal isn't happening. Crucial. No closing means the 3 business days prior to consummation rule doesn't fit. Instead, it's 30 days from denial or withdrawal. Differentiate this 30-day rule. It's specifically for valuations after a denial or withdrawal.
Okay, 30 days after denial withdrawal to get the appraisal copies. What else?
Second, 30 days. Request for adverse action reasons. Remember, the adverse action notice has to give reasons. Well, maybe it didn't list the specific reasons. Maybe it just gave a general code or referred them elsewhere. If the applicant asks for those specific reasons, the creditor must provide them within 30 days of getting that request. So that's a 30-day response window for the creditor triggered by the applicant asking.
And how long does the applicant have to ask?
Good question. That leads to the third point. 60 days. Right to request reasons. This works hand in hand with the last one. An applicant has the right to request that statement of specific reasons within 60 days of receiving the adverse action notice. So see the sequence. Applicant gets notice. They have 60 days to ask for specific reasons. If they ask, creditor has 30 days to provide them. These last 2 timings, the 60-day applicant request window and the 30-day creditor response, very, very frequently tested together. For your perfect score, memorize both. Understand their order, 60 days to ask, 30 days to answer.
60 days to ask, 30 days to get the answer. Got it. That's a key pair. And finally, record keeping. This feels like an easy point if you just know the number.
Yes, this one's straightforward, but absolutely required. Record retention. A creditor has to keep all the relevant records for at least 25 months after telling an applicant about action taken or incompleteness. That mandatory period is 25 months. Firm number. Lock it in. 25 months. Now, this primarily applies to consumer credit transactions. For business, commercial, ag credit, remember, ECOA covers those too. The retention is a bit shorter, 12 months. But the exam mostly focuses on the 25 months for consumer credit. Just be aware of the 12 for business.
25 months for consumer. What records exactly?
Good question. What needs keeping? The application itself. Any info gathered from monitoring like HMDA data, we'll touch on that. Any other written or recorded info used in the evaluation, credit reports, income docs, notes, the notice of action taken itself, and the statement of specific reasons for any adverse action. That 25 months is crucial. Why 25? It lines up with the statute of limitations, making sure records are there if a dispute or investigation comes up.
Okay, let's look at the different ways discrimination can actually happen and how ECOA tries to stop them. It's not always just a flat-out no, right? Sometimes it's sneakier.
That's a really crucial point. Discrimination under ECOA isn't just one thing. It takes several forms, and you absolutely need to know the differences for the exam. First, there's overt discrimination. This is the most obvious kind. Blatant, unmistakable. A clear refusal to offer credit because of a prohibited basis, an explicit policy or statement. The classic example, redlining. You've probably heard of it.
Yeah, drawing lines around neighborhoods on a map, right?
Exactly. Creditors refusing to make loans in certain areas, not based on the applicant's creditworthiness or the property value, but purely because of the personal characteristics of the people living there. Their race, national origin, religion, literally drawing a red line around areas and saying, we don't lend there. Overt discrimination. And there's a flip side, too. Reverse redlining, equally bad.
Reverse redlining, what's that?
That's where predatory lenders specifically target neighborhoods, often ones with elderly, immigrant, minority populations. And they push risky loans with really oppressive terms, high rates, crazy fees, balloon payments, because they think those folks are less savvy or have fewer options.
Yeah.
Both are clear, overt discrimination.
Okay, overt is the obvious stuff. What else?
Next, disparate treatment. This happens when a creditor treats a loan applicant from a protected class differently than other similarly situated applicants who aren't in that protected class. The key phrase there is similarly situated.
Meaning, like, same income, same credit score.
Exactly. Two people, comparable income, credit score, DTI, property value, everything relevant is the same. But they get treated differently because one is, say, female and the other male, or one is Hispanic and the other isn't. Maybe the lender consistently gives higher rates or demands more paperwork from one group, even with identical financial profiles. That's disparate treatment. Inconsistent application of policies based on protected characteristics. Very common form of discrimination.
Okay, treating similar people differently based on a prohibited reason.
Yep.
Got it. What's the third type?
The third one is disparate impact. This one's more subtle, often harder to spot, but just as illegal. It happens when a policy seems neutral on its face, applied the same way to everyone, but it ends up having a disproportionately negative effect on a protected class, even if the creditor had zero discriminatory intent.
So the policy itself isn't discriminatory, but the result is.
Precisely. The crucial things here are neutral policy and without discriminatory intent. It's the effect that matters, not the motive. Example, a lender has a neutral policy. Minimum loan amount is $150,000 for all mortgages. Seems fair, right? Same rule for everyone. But what if data shows that applicants from, say, a specific racial minority group, maybe due to historical wealth gaps, disproportionately apply for loans under $150K in their communities? Then that neutral minimum loan policy could have a disparate impact on that protected group. Even if the lender didn't mean to discriminate, it's the outcome, the result, that triggers the ECOA violation.
Wow. Disparate impact seems really complex to identify. Okay, those are the types. Now, what about specific questions lenders just cannot ask, or things they just cannot do? Strict off-limits stuff under ECA?
Exactly. These are direct violations. You need to know these codes. Starting with prohibited inquiries. Creditors absolutely cannot ask about plans for having children or about birth control practices. That's considered highly intrusive, historically used to discriminate, especially against women. So family planning questions, totally forbidden. And like we drilled down on before, marital status when asking. Only allowed to use unmarried, married, or separated. Say it again. Only those three terms. Asking, are you single, divorced, widowed, living together? Violation.
Okay, no family planning questions, only the three specific marital status terms. What about race and ethnicity? Did you say sometimes that's required?
Ah, yes, good catch.
Yeah.
There is a very important HMDA exception, crucial for your exam, frequently tested. Normally, under ECOA, asking about ethnicity, race, sex, generally prohibited. However, those inquiries are permitted and actually required for monitoring purposes under the Home Mortgage Disclosure Act, HMDA, but only for transactions secured by a dwelling.
Okay, so HMDA requires it for mortgage loans, basically, for tracking purposes.
Exactly. HMDA is a separate law, helps track lending patterns, identify potential discrimination. When asking for this HMDA info, creditors must tell the applicant it's for federal monitoring and that giving the info is optional. If the applicant chooses not to provide it, the creditor then has to note the info based on visual observation or surname. You must know this exception. And its conditions, HMDA. Dwelling secured transactions. It's a classic exam trick question.
HMDA exception for monitoring dwelling secured loans. Got it. What other prohibited practices?
Another big one is discouragement. Creditors can't make any statements, oral or written, that would discourage a potential applicant from a protected class from even applying. It's not just outright denial. It's subtle steering, like quoting higher rates than are really available for someone's profile, offering worse terms, making negative comments about a neighborhood or an income source, giving misleading info to steer someone away. Even a casual comment like, "Are you sure you want a loan in that neighborhood?" could be discouragement if aimed at a protected class.
Wow, that's broad. Discouragement. Okay. What about co-signers?
Right, requiring a co-signer. A creditor cannot demand the signature of a spouse or anyone else if the applicant individually qualifies for the credit based on their own income, credit, assets. This trips people up. If you qualify on your own, they can't force you to bring someone else onto the loan, even your spouse, just because of your marital status or sex.
So if I qualify a loan, I don't need my spouse on the loan. Unless there's an exception, right? You mentioned something tricky.
Yes. Here's the critical nuance, the exception for the exam. Pay close attention. Community property states. States like Arizona, California, Texas, several others. In these states, assets acquired during marriage are usually considered jointly owned. Because of that, a non-borrowing spouse's signature might be required, but only on the security instrument.
Security instrument, like the mortgage document itself.
Exactly. The mortgage, the deed of trust, the document that legally ties the property to the loan as collateral. Why? To create a valid lien. To make sure the lender has a full claim on the collateral if things go bad. But here's the crucial part. That signature is not required on the promissory note. The note is your personal promise to pay, tied to your creditworthiness, so community property state. Non-borrowing spouse might sign the mortgage to secure the collateral, but not the note if the borrower qualifies a loan. This community property state exception, notorious exam detail, know it. Understand the difference. Security instrument versus promissory note, essential for your perfect score.
Mortgage, yes, note, no, in community property states if borrower qualifies a loan.
Wow, that's specific. Okay, task 1, income. Yes, income considerations. Creditors cannot refuse to consider income just because it comes from public assistance, pensions, annuities, or regular alimony or child support, provided, and this is the important qualifier, provided it is likely to continue. So, consistent, verifiable income from Social Security, a pension, court-ordered support. Got to treat it like job income. Can't just discount it because of the source. Lenders can ask for proof it's consistent and ongoing, like divorce decrees for alimony, benefit statements. But they can't refuse to consider it as legitimate income if it's likely to continue.
Okay, so ECOA isn't saying you can't judge if someone can repay a loan. You absolutely have to. It's about how you assess that risk, right? Making sure it's not based on those prohibited factors. So what can lenders permissibly consider when looking at creditworthiness? How is that different from discrimination?
That's a key distinction.
Yeah.
For the exam and for practice. ECOA lets creditors consider any information, basically. As long as it's not used to discriminate on a prohibited basis, it's all about assessing legitimate credit risk. So, what's permissible? Let's talk age. A creditor can definitely consider if an applicant is old enough to legally sign a contract. That's just basic contract law. Also, in those complex, statistically sound credit scoring systems, age can be used as a predictive variable. But, critical caveat, as long as an elderly applicant's age, remember 62 or older is not given a negative factor.
So age can be neutral, maybe even positive, but never negative for older folks.
Exactly. It can't penalize someone just for being, say, 65 if they're otherwise creditworthy. A system might look at years at current address, which might correlate with age, but it can't dock points just for being older. Important distinction for the exam.
Okay. What about income again? We touched on sources, but what about amount?
Income. Yes, a creditor can obviously consider the amount and the probable continuance of income, standard underwriting. And like we said, income from public assistance, pensions, annuities, regular alimony child support must be considered if it's likely to continue consistently. Lenders can, and usually do, ask for verification for these sources, just like they would for job income, to make sure it's reliable.
Makes sense. How about credit history?
Credit history. Totally permissible to consider the history of accounts belonging to the applicant and their spouse. Standard practice. But here's an important point. Upon request, a creditor must also consider information an applicant brings forward to show that a credit history being considered doesn't accurately reflect their creditworthiness. This helps people with maybe incomplete or misleading reports, like if a spouse's bad history is dragging things down, but the applicant can show they manage their own separate accounts responsibly. The lender has to consider that information.
Good to know. Okay, now this next one often causes confusion. Immigration status versus national origin.
Yes, this one trips people up all the time because they sound similar, but legally they're distinct under each ECOA. Immigration status. Okay, remember, national origin is a prohibited basis. You cannot discriminate because someone is from, say, Mexico or Nigeria. Forbidden. However, the law does not prohibit considering an applicant's immigration or residency status if it's relevant to determining the creditor's rights and remedies for repayment.
Okay, how does that work practically?
It's a fine line, but crucial for the exam. You can't deny someone because they're from another country. That's national origin discrimination. But you can consider their immigration status if, for instance, they're on a very short-term visa that expires long before the loan term ends. Why? Because that status might make it practically impossible for the lender to collect on the debt or enforce the loan contract if they default. The focus has to be on the practical ability to enforce the loan, not bias based on where they come from. Understand that difference. National origin, prohibited versus immigration residency status, permissible only for assessing repayment remedies. Common point of confusion. Nail it down.
Okay, that distinction is vital. National origin, bad. Immigration status, okay if it directly impacts collecting the debt. Got it. Now, something fascinating you mentioned earlier, self-testing. Sounds like lenders policing themselves. How does that work?
Exactly. Self-testing is a really important compliance tool that regulators actively encourage. EUA allows, even encourages, creditors to conduct these self-tests, to find potential violations in their own systems before the regulators do. It shows they're proactively trying to ensure fair lending. This often involves using testers.
Testers, like secret shoppers for loans?
Kind of, yeah. Paired individuals who pose as loan applicants, they're usually given very similar financial profiles, income, credit, etc., but they differ on one protected characteristic, race, sex, whatever. Then they apply for credit, go through the process, and compare how they were treated. Did the black tester get quoted higher rates than the white tester? Did the female tester get asked for more documents than the male tester? These tests can uncover subtle stuff like disparate treatment.
So lenders do this to themselves. Isn't that risky if they find something?
But here's the critical protection, the incentive. Information from self-testing is protected as privileged, meaning generally it can't be used against the creditor in court or by regulators, but there are two conditions for that privilege. You need both. One, the creditor has to keep the test results confidential. Two, the creditor must take corrective action to fix any discriminatory practices they find, promptly and effectively. So, it's a deal. Find your problems, fix your problems, keep it quiet, and the test itself won't usually be used to punish you. It really encourages self-policing and fixing issues internally. Better compliance overall.
Okay, nobody wants to violate ECOA, obviously.
Yeah.
But if it happens, what are the real consequences? What penalties, what damages could a creditor face? And what are the specific numbers listeners absolutely must know for the exam here?
Right. This is where the rubber meets the road regarding law and compliance. And yes, these numbers are absolutely fair game for your exam. Gotta know them. EQA allows successful plaintiffs to recover actual damages. That's the real financial loss the applicant suffered because of the discrimination. Could be things like paying higher interest than they should have, lost opportunities, maybe even emotional distress damages in some cases, provable losses, and then there are punitive damages. These aren't about compensating the victim, they're about punishing the violator and deterring them and others from doing it again.
Okay, actual damages for the harm. Punitive to punish. What are the limits on punitive? These are the numbers to memorize, right?
Exactly. Here are the figures you must commit to memory for your perfect score. For individual actions, if just one person sues successfully for an EKA violation, punitive damages are limited, capped at $10,000. Let me repeat that. Punitive damages, individual action. $10,000 maximum. $10,000.
$10,000 for an individual.
Okay.
What about class actions? When a whole group sues,
Class actions, right, lawsuits brought by a whole group who suffered similar harm. Here, punitive damages can be much higher, but there's still a limit. It's the lesser of two amounts. $500,000 are 1% of the creditor's net worth. Whichever number is lower, that's the cap.
lesser of $500 K OR 1% net worth, not A&D, it's OR. Okay, can you give an example?
Sure. Let's say a big bank has a net worth of $60 million. 1% of that is $600,000. In that case, the punitive damages cap would be $500,000 because $500K is less than $600K. But now, say it's a smaller lender, net worth $30 million, 1% of that is $300,000. In that case, the cap would be $300,000 because $300 is less than $500K. You must remember, lesser of $500,000, 1% of net worth. Understand that calculation. It's a common place to make a mistake on the exam.
That's sort of $500K or 1% net worth for class actions. Got it. Anything else besides damages?
Yes. In addition to actual and punitive damages, a successful consumer can also be awarded the costs of bringing the lawsuit and reasonable attorney's fees. So the creditor could end up paying not just damages, but also all the legal bills for the person who sued them. Adds up fast. These numbers, $10K individual, $500K 1%, class action, extremely important. Memorize them.
Okay, penalties memorized. Now, what about the time frame for suing? The statute of limitations, we've talked timelines. How long do people have to act?
Another set of crucial numbers to internalize. Perfect score material. The general statute of limitations for an individual person to file their own lawsuit for an ECOA violation is 5 years. 5 years from the date the alleged violation actually happened. So from the day they were discriminated against, they have 5 years to sue. The same 5-year period generally applies to class actions too, and also to lawsuits brought by the U.S. Attorney General, usually when they find a pattern or practice of discrimination. So rule of thumb for most cases, 5 years.
5 years, okay. Is there an exception? You mentioned one earlier, I think.
Yes. There is that one key exception. You must differentiate this for the exam. It's designed to protect people who might not even know they were victims until later. Let's say the Attorney General does sue a lender for widespread discrimination, and through that government lawsuit, an individual finds out, hey, that happened to me too. In that specific situation, the individual then has 1 year from the date the Attorney General filed the government's lawsuit to bring their own private lawsuit. So generally 5 years from the violation, but a specific 1 year window starting from when the AG files, if that's when the person found out. This 1 year exception. Critical detail. Very common trick question potential. Know it cold. 5 years general, 1 year after AG action.
Okay, got it. 5 years is the main rule, but only 1 year if you find out via an AG lawsuit. That's tricky. Wow. Okay. You've just received an absolutely intensive high-yield masterclass in ECOA and Regulation B. Seriously, meticulously designed to help you nail that perfect score on the NMLS SAFE exam. We went from the why, that history of fighting discrimination, especially against women, all the way to the broad scope, covering brokers, business loans, everything. We locked down those vital definitions, right? Adverse action nuances, those only 3 terms for marital status, and most critically, we drilled those numbers. 3 business days for appraisal notices, 3 business days for copies before closing. Those multiple 30-day rules, completed apps, incomplete apps getting reasons after denial. The 90 days for counteroffers. That solid 25-month record retention. And just now, the 10-guy and 500 1% penalties, and the 5-year and 1-year statutes of limitations.
Don't forget disparate treatment versus disparate impact.
Right. And the different types of discrimination: overt, disparate treatment, disparate impact. Plus those tricky exceptions: HMDA monitoring, the community property state cosigner rule, understanding not just what ECOA stops, but how it's enforced, the precise timelines. That's your absolute key to hitting 100 on this section.
That's absolutely right. Remember, every single detail we've unpacked today, from appraisal timing down to cosigner rules in specific states, it's all fair game on the SAFE exam. These aren't just fuzzy concepts, they are testable facts. You need them. So go back through your notes right after this. Spend extra time on those numbers, those precise definitions. You need to recall them instantly. Apply them accurately to whatever scenario the exam throws at you. And, consider this. Understanding these details, these granular bits of ECOA, it doesn't just help you pass a test. It fundamentally changes how you approach fair lending. It makes you a more ethical, more effective mortgage professional. Makes you think, doesn't it? What other common practices out there might, if you look closely, have those unintended disparate impacts that ECOA is trying to prevent? Keep asking those questions, even after the test.
That's a really powerful thought to end on. Connecting this exam prep to the real-world impact. You've definitely got this. Keep diving deep, keep learning, and we'll catch you on the next deep dive.